And let's start there. I know we're kind of looking a little bit further out here, Ben, but do you see any potential for disruption out there?
Well, it's a great question, and thanks for having me on. I think the credit fundamental story in munis is one of the most compelling stories that we've got in the municipal market. As probably a lot of people know, in 2022, credit fundamentals were very, very positive across most of your traditional municipal sectors. Of course, there's state general obligations, there's city and county general obligations sectors, but there's also acute care hospitals, transportation, utilities, education, et cetera. So there are literally over dozens of sectors involved in the municipal market, all of which operate in different formats in different portions of the credit cycle. So when you do have government slowdown, it's interesting to note in the muni market, it doesn't really impact all of the sectors at the same time. A lot of diversification.
I am curious to kind of about the state of investor appetite right now in the muni space. I mean, we saw a lot of outflows early this year out of some of the key funds here. And I don't know if that had to do with concerns about economic conditions, or maybe it was just competition from returns that you can get in other investments. But where do we stand right now?
Yeah, I think one of the most compelling stories in the muni market right now is just the high absolute yields. You really have to go back to taper tantrum, fall of 2013 to pick up yields like we're able to pick up in today's market. So just a couple of data points there. 30-year AAA munis right now are yielding a little bit more than 4.3%. And as you know, the municipal market's a very high credit quality asset class. If you go down the investment grade credit spectrum, down into the AA, single A, triple B portion of the municipal market, those yields are north of 5% for the triple B index, which on a taxable equivalent basis is north of 8%. So it's a very compelling opportunity right now, just from an absolute yield perspective for munis. You're absolutely right that open-end fund flows were very negative in 2022. They've stabilized somewhat in 23, but we think there's a lot of cash sitting on the sidelines waiting for these opportunities.
Well, Ben, that's what I wanted to talk about. What are munis competing with? Are they competing with money market mutual funds? Are people just happy to sit in cash where they can get comparable, if not higher yields?
Yeah, absolutely. They're very happy sitting in cash. So I'd say that's the number one piece of competition for the municipal market is, investors just sitting in money markets or cash equivalent type of investments. We have seen a lot of interest over the last couple of weeks and months as these yields have just continued to rise for people pushing out from cash and cash equivalents into the fixed income markets to get a little bit more, normal asset allocation. We think one of the big positive catalysts for flows really to come back into the municipal market will be the yield curve inversion flattening, and then ultimately getting to a much more normal upward sloping nature to the yield curve. And we've seen some steepening here just even over the last couple of weeks.
Yeah, and that's actually what I was wondering. What actually will be the catalyst? Is it yields on cash and some of these short-dated, very safe instruments coming down, or is it long-end yields actually getting to a point where people can't resist?
Yeah, I think it's a very good question, and I think the FOMO, the fear of missing out that investors have sitting in cash, if they miss this opportunity to invest out the yield curve and lock in some of these really attractive rates, will be very real. So I think the muni market is uniquely inefficient because it's a retail-driven asset class. It's not really an institutionally driven asset class. So being a retail-driven asset class, it tends to be more inefficient. So when the moves happen, they tend to happen very, very quickly. And so with any sort of flattening to the yield curve or an upward sloping nature to the yield curve, I think that'll be a very positive catalyst for money flowing right back into open-end funds in particular.